We have to spend a few minutes in order to understand all the consequences of seg funds, especially for the contract owner, looking at the taxation of seg funds. Now, we're going to assume that we're dealing with a non-registered segregated fund. If you're dealing with a registered segregated fund, that is within an RRSP or a RIF or a LIRA, that's what you're going to see in Module 14 in the RRSP section. So what we're looking at here is just this basic taxation of a non-registered segregated fund. This is going to be taxed much the same as other sorts of capital property. So let's say we have somebody who invests $1,000. Now we know that the amount that you initially invest for the terms of a capital gains calculation is referred to as your ACB, your adjusted cost base. You'll note that we're not dealing with adjusted cost basis like life insurance. With seg funds, we're dealing with adjusted cost base, ACB, which means it's subject to the same treatment as other capital property. That'll be that 50% taxation that we're used to now, where only half of your gain or loss is taxed. So you have $1,000 invested. Ideally, you get some growth here in the form of interest, dividends, and capital gains. Easy enough. And what we're going to do, just as we did with our mutual fund, we're going to take that money and we're going to automatically reinvest it. This does point to one tiny little difference between segregated funds and mutual funds. It's just a terminology difference, is that this regular reinvestment with a segregated fund is referred to as an allocation. In a mutual fund, that was referred to as a series of distributions. Now, as we make these allocations, these are going to be taxable events. So the fund generates this interest, dividends, or capital gains, and just like with a mutual fund, in fact, there's a lot less flexibility with segregated funds here in general, this is taxable to the annuitant as it happens. Sorry, I misspoke here. I said tax the annuitant as it happens. That's not right. I should say here tax to the policy owner. As it happens, it's the policy owner who's going to deal with or enjoy the tax consequences of a segregated fund. Now, that's what happens when we have a gain here. There's a different treatment of segregated funds when we have a loss than we would expect with other types of investments. So let's say that this $1,000 falls in value, and each year we have this drop in value because the underlying investments happen to be losing value. This would result actually in a series of capital losses. With a mutual fund, for example, you would only have a capital loss if you invested and held on to that investment for a period of time, and then on redemption you got out at a lower value. You would then realize your capital loss. But with a segregated fund, this capital loss happens each year as you lose value in the fund. You're obviously not hoping for that to happen, but it is an upside from a tax planning perspective, because as you will recall from Module 6, a capital loss can be used against a capital gain in any of the previous 3 taxation years, or it can be carried forward indefinitely. Now, in both of these cases, whether we have gains or losses, we're going to have a long-term consequence to those gains or losses. And the long-term consequence here is that we will be changing our ACB. So as we have this ongoing series of allocations, so will our ACB increase. So with a seg fund, generally what happens is at maturity, the ACB is going to be equal to the market value. And that means that you're going to have typically not a lot of capital gains at redemption or at maturity for your seg fund contract, because the ACB will have increased all the way along. Mutual funds have a lot more flexibility in how they can do that. So with mutual funds, you may not have these tax consequences on an annual basis, but you may have a larger capital gain at redemption. The reverse really is what happens when we have this series of capital losses. You started off with this high ACB, and you end up dropping that ACB with each of these subsequent capital losses. Now let's say that we have, and work with me for a second here, this is going to get a little complicated. Let's say that we have somebody who invested $1,000 and their contract has fallen in value, let's say, to $600. We saw a similar example in an earlier slide. And at this point, our annuitant dies. If we have a 75% death benefit guarantee, we know this is going to result in $750 paid to the beneficiary. And the beneficiary will receive that money tax-free. They're not going to have any tax consequences. But let's say that our ACB at this point happens to be $620, which would be fairly realistic. Maybe we've had a little bit of loss that hasn't yet been represented on a T3 issued by the insurance company. So we can see that this beneficiary is getting $750 where there's an ACB of $620. You should recall from the capital gains discussions before, this is going to be a deemed disposition or a disposition of this contract, and we are going to have here a $130 capital gain. Now in reality, Revenue Canada hasn't come up with a definitive position on this, but this is supported by some literature that Revenue Canada has produced. So it seems like this should be taxable as a capital gain, and this capital gain would be taxed to the contract owner, which is why I say that our beneficiary receives that $750 tax-free, but it's not actually tax-free in the big picture. The contract owner still has that tax consequence to deal with. And keep in mind that generally the contract owner and annuitant will be the same person. Now if you go the other route here, you have somebody who invested this $1,000, and let's say that at maturity they have an ACB of $1,800 and a market value of $2,000. That would result in the difference between those two amounts, $200. That would result in a $200 capital gain. I think we can appreciate that. That's fairly straightforward. So that $200 capital gain, we would apply our 50% inclusion rate, and we're all good. Now the one other thing to demonstrate here is that it might seem unfair that you have this $130 capital gain, but keep in mind you've had these capital losses all along, and you could use these capital losses, you can carry them forward indefinitely, you could use these capital losses to offset that capital gain. That is a possibility if you haven't already used them. So the taxation of segregated funds is a little bit complicated. We do have a little bit more to look at here, and that is the taxation of a partial withdrawal. That's going to be taxed on a partial basis in a similar manner to what you saw with a partial withdrawal or a proportional withdrawal from a universal life contract. So let's have a look at that. Give everybody a second here to grab all of this. So now, what happens if you have somebody who invests this $1,000 and this investment grows, let's say, to $2,000, and along the way we've had $800 of taxable allocations. Well, at this point, we're going to have an ACB of $1,800. So if this person were to make a complete withdrawal, if they were to clean out that fund, there would be a $200 capital gain waiting for them. So we have a potential $200 capital gain. But let's say this person just makes a partial withdrawal. They decide that they're only going to take out a portion of what they have invested. They decide to withdraw, let's say $500, just for the sake of argument. It doesn't really matter. $500 is, as a proportion here, 25% of what they could have withdrawn. So it's a 25% proportion. Now we said if they took out the whole amount, they would have a $200 gain. Just like we saw with the taxation of universal life insurance, we say, hey, that's going to cost them 25% in tax terms of what it would have cost them to make that full withdrawal. So instead of having a $200 capital gain because they've only taken out 25%, they're going to have a $50 capital gain. And then we would take that capital gain times 50% as with a normal capital gain, and we get to $25, and this person would have to include $25 in income, and that would be multiplied times their tax rate, times their marginal tax rate, and that would give us the tax payable. So that's not too complicated, but you do have to remember this proportional calculation when you have this partial withdrawal from a segregated fund contract. For exam purposes, you're likely to see 1 or 2 questions on the taxation of segregated funds. In real life, if you're dealing with these investments, you're inevitably going to have questions about how the tax consequences are working for your clients, especially with non-registered investments. Thanks very much. I hope you found this useful.